So basically here we're going to look at what we call the 5 C's of credit. The 5 C's of credit are those considerations, those factors which must be analyzed by a bank after a careful illustration and analysis of the creditworthiness of the client or of the borrower. They will be able to ascertain whether it's worthwhile granting a facility to the borrower. This is because from there the financial institution or the lender will be able to know whether the borrower will be able to pay the principal as well as the interest that are being contained in the loan agreement. So let's look at the main characteristics of the 5 C's of credit. We're going to look. The first C here is going to be character. The second C there will be capacity. The third C there is capital, and then the fourth C is collateral, and then the last C there will be what condition. So let's have an explanation, a brief explanations of what these three C's actually represent. Here, the very first one, which is character, the company's history, reputation, and management's attitude towards risks and growth. So basically, we're saying that at this level, the financial analyst or the credit analyst, from the point of view of the bank, will be trying, assuming that the company wants to obtain loan from this bank. The credit analyst will be trying to look at the history of this company when it comes to maybe meeting up with their previous financial obligations, the principal as well as the interest with their previous bank. So they will try to like establish their history to know whether they have been settling their previous loans which they have been taking from other financial institutions or not, getting to know their reputation in the market, getting to know whether the management has a good attitude or the impression or the attitudes of their management towards risks, and how what are their plans for future growth. You'll be trying to know whether this company really has any potentials of growth for growth or not. So that is the first character that is representing the first C of credit rating. And the second C here is capacity. Now the most important thing at the level of this capacity means that you'll be trying to analyze the profitability of that business of that company, and then trying to analyze their cash flow, or to see whether from their cash forecast or from their cash forecast and the growth potentials of that business, to know whether at the end of the day the company will be able to have sufficient resources to be able to repay the principal as well as the interest on a monthly basis. So it's very important. So that's why capacity there. Capacity is simply representing the company's ability to generate profitability as well as to have sufficient cash flows that they can maintain their operations, especially making sure that the loan repayment of the principal and the interest are being paid on a routine basis. Now we have the next video, which is representing capital. Now here we're trying to look at the overall capital structure of that particular organization, to know whether the company is lowly geared or is highly geared. We really understand that if a company is highly geared, there are high possibilities that if it is not very profitable, or if they don't have a huge cash flows, they may not be able to meet up with their debts. Why? Because the rate of interest is going to be very high, and if the business is not performing very well, then it means that there's a risk that they will not be able to repay the principal as well as the interest, that if we grant them a facility. This is so because you understand that they already have other existing facilities with other financial institutions. So it may be risky if we move ahead to grant them another facility. That's why we need to analyze and make sure that these facilities are not being exhausted. However, if the company is lowly geared, we know that it's comfortable that the company will be able to repay the principal as well as the interest from the loan they borrow from us. Then collateral, we need to know whether they have any assets or any properties that should, in case they are unable to meet up with the obligations, we can dispose of these assets to realize our facility which has been granted to them. And the one there is the condition. Now we're trying to look at the attractiveness of the industry as well as the competitive advantage that that company has over other rivals. If you realize there's a company that has a competitive advantage and has a lot of market opportunities in the industry in which they're operating, it means that there are also high possibilities that they'll be able to generate, they'll be profitable, as well as they'll be able to generate sufficient cash that will enable them to be able to pay our facility composing of the interest as well as the principal. In our next session, we'll go more to look at the various types of credits and the types of loans that have been granted by financial institutions. Like I explained, always subscribe to the Dicalo Consulting website, YouTube channel, so that you will always be updated on any new